Welcome to Managerial Accounting. Today's day 21 for the fall 2022 semester. We're going to be working on chapter 24 today. And so the chapter 24 exercises should be submitted for grading in Cengage by the end of the day today. Next Tuesday, then the chapter 24 problem would be due. Next week, we'll be covering chapter 25. And so the 25 pre-quiz would be due on Tuesday as well. And as you know, the annual report project is also due on Tuesday. If you submitted a rough draft, I haven't gotten to those yet, but once I get to them, you will have plenty of time if you choose to make any changes. So if you submitted a rough draft, don't get anxious about feedback thinking I've got to have it in by Tuesday. If that's not sufficient time based on when I give you feedback, we'll give you additional time for that. If you did not submit a draft, though, your report is due on Tuesday. So, any questions? Any questions about what's coming up, what's due, anything? Chapter 25 that we're covering next week is the final chapter on our exam 3. And so just as you're looking ahead, you know, we have the week off for Thanksgiving, but before that week off, you will be taking exam 3. So if you are planning to leave the college for that vacation, again, make sure you plan to take exam 3 before you are gone. So the exam window is Thursday through Sunday, but vacation for Thanksgiving kind of starts on Saturday. So you might want to plan to take that exam on Thursday or Friday of that week. Definitely it should be taken before you take off for Thanksgiving. And then after Thanksgiving, we have just 3 more weeks. And well, really just 2 more weeks of class. And then our last exam will cover those final 3 chapters. So chapter 24 is what we started on Tuesday. We were talking about responsibility accounting and only evaluating management performance based on those costs and revenues that come under their direct control. We talked about appropriate ways of allocating support department costs that are maybe incurred at the corporate level, and then we allocate those costs to the individual units that are supported at that headquarters, if you will. We talked about, really, I mentioned 4 different types of responsibility centers, but we really only did exercises related to 2 of them. So we talked about profit center. Let me start at the lowest level. We talked about cost centers where there are costs incurred, but they're not responsible for any revenues or sales. And so that was the lowest level in terms of complexity that we discussed and we looked at in our exercises. I also said there is another version of that called a revenue center where they're really responsible for sales, but not the cost piece of that. We didn't have any exercises related to that concept. Stepping up from there, we have a profit center. And in a profit center, the management is responsible for both revenue and expenses. And so we're really looking at kind of the controllable income statement as a whole. And that's the analysis we did in the final exercises on Tuesday. So what we have left to cover today is, just pull this up, is the most complex, the highest level of authority or responsibility is an investment center. And so all of the exercises that we look at, starting with exercise 7 today, will be related to evaluating an investment center. And so that'll be exercises 7, 8, and 9. And then the final exercise we look at is related to the concept of transfer pricing. And we'll get to that shortly. So an investment center not only has responsibility over revenues and costs like a profit center, but they also are responsible for how the assets are invested in that division or that unit of that operating unit of the business. And so for an investment center, we're not just looking at income statement type analysis. Instead, we're going to be comparing information from the balance sheet, that is the assets that they have, and how well are they using those assets to promote the business, to generate revenues, to generate income. And so the analysis or the evaluation of an investment center is definitely at a much higher level than what we've seen up to this point. And so we're going to be looking at a couple of different measures that we might use that would be appropriate for an investment center. And you can see both of those at the bottom. At the bottom of this slide, excuse me, return on investment, or ROI, and residual income, or RI. So return on investment is the focus of exercise 7, the first one we're going to do today. So as we look at at the screen now, you can see the divisional income statement where we have 3 separate divisions, and all of this information is the same type of information that we might use for a profit center. There's nothing here that indicates what assets or what hard assets each of these divisions had available for use. And so as we look at return on investment, we need to bring in that picture of, we can see what they did on the income statement, but what did they have available to help them to produce those sales, to produce that income? So you can see at the bottom of this slide, the formula that we will be using. This is the basic formula for ROI. I'm going to show you what's called the DuPont formula, which gives us a little bit more insight into where does this information come from, or if a manager wants to improve their ROI, what do they need to do to have that happen? So this again is the basic formula. You may want to make a note of that: operating income divided by invested assets. So again, we're comparing a value from the income statement to a value from the balance sheet. And that's the first time, this will be the first time that we have done that. There we go. So I said I wanted to show you the DuPont formula which is really a more complicated way of getting at exactly that same calculation. The DuPont formula is also a return on investment formula. And the answer, if you will, the result of the calculation is the same, but the DuPont formula allows us to see if we want to improve our ROI, what do we need to do to have that happen? And so go to the next slide. So we know from the first formula I showed you that return on investment is operating income divided by invested assets. And you can see in the DuPont formula down here at the bottom, the result of this, operating income divided by sales times sales divided by invested assets, the sales divided by sales is just 1, so that simplifies or cancels out. And we'd end up with the same formula, operating income divided by invested assets. But these 2 pieces in the DuPont formula, get my box up here. These 2 pieces, 1, 2, have a specific, so that's profit margin and that's investment turnover. So profit margin is, of each dollar in sales, how much do we get to keep as income? And investment turnover is, how good are we at using the assets we have to generate sales? The reason that I want to show you this, what seems to be a more complicated formula for finding return on investment, is if we have a manager, if we want to improve our ROI, this shows us 2 different ways we can do that we can leverage either our profit margin that is to keep more of each dollar in sales, or we could focus on improving our investment turnover, that is using our assets more efficiently to generate sales. Improving either one of those then would improve our ROI. And this gives us a better way of focusing our attentions. If our goal is to improve ROI, which is a very reasonable goal for an investment center, how do we do that? Well, we can generate more sales with what we have available to us with the assets, or we can focus on improving our profit margin, keeping more of the sales we have, that is lowering our expenses as a total percentage of our sales, improving our profit margin. So hopefully while I was explaining those, you've made a note of these formulas so we can go take a look at our first exercise for today, which again is exercise 7 for chapter 24. There we go. Excuse me. So exercise 7 says the operating income and the amount of invested assets in each division of Conley Industries are as follows. So we have three divisions, retail, commercial, and internet. We have their operating income and their invested assets. Because of the way this information is provided to us, we can use that basic formula that we saw for ROI. And that is operating income divided by the invested assets. So for the retail division then, operating income divided by the invested assets. You'll notice we express ROI as a percent. So if you are using a calculator to calculate that, make sure that you move the decimal 2 places to the right anytime you are changing a decimal into a percent. And if you got 24% for that one, go ahead and do the same calculation for the commercial and then the internet division. So I know that none of you had me for financial accounting, but in financial accounting, as we start looking at this type of financial analysis, I always talk about what I refer to as the standards of comparison. And I'm not sure how much we've talked about in this class, because mostly what we've been looking at is internal, internal reporting. So let me just talk for a moment about standards of comparison. So anytime we do a financial analysis, which is what we're doing here, we need to be comparing our results to something. So we can never just look at a number in a vacuum and say that's good or that's not very good. So when I look at the retail division and say, well, their ROI was 24%, how is that? I don't know. How is it compared to what? So we have 3 different standards of comparison that we are likely to use. The first one is a rule of thumb or a heuristic. And so sometimes there might be kind of that magic number that we're looking for. And I don't have a magic number for ROI. I don't know a rule of thumb because it really depends on the industry in which the company is operating. And this exercise does not tell me what Conley Industries does. So I can't look at that 24% and say that's great or that's not good enough. We need to be comparing it to something else. So I don't have a rule of thumb for ROI. But the other standards of comparison are that we might compare ourselves to ourselves, which is a time series or a horizontal or a trend analysis. And I know not all of you got to chapter 14 in financial accounting. But this piece, then number 2, standard of comparison, is really what I'm asking you to do in that annual report project in the financial analysis part of that. And we talked more about the project last week and earlier in the semester, but remember I pointed out to you that the project, the financial analysis piece of the project, which is 30 out of the 80 points for the project, requires that you do the calculation for 2 years and then discuss the significance of what you found. And so the 2 years tells us that we're doing this horizontal or trend analysis. We're comparing how did the company do this year or the most recent year compared to how they did the year before that. So we're looking at the most recent 2 years. Did they get better or did they get worse? And so horizontal analysis that is covered in chapter 14 in most in our textbook, and it's covered in the final chapter in most financial accounting books, really is looking at that horizontal. What we are doing in the project is that horizontal analysis where we're comparing 2 years side by side. A trend analysis would typically look at more than 2 years. So maybe you're looking at the last 4 to 5 years worth of data, or even longer than that. The other standard of comparison that we might use is to compare ourselves to the competition, to the industry. So we might be looking at an industry average, or we might be looking at maybe our chief competitor, our closest competitor. Maybe we're number 2 in the industry, and we look at number 1 in the industry and say, we want to do better than they are. And we call that process benchmarking. When we pick just one company, we say, that's the standard that we want to live up to. So as we're looking in this particular exercise, I can't look at the retail division and say, how are we doing? How's 24% ROI? I don't know. But for question B, which division is the most profitable per dollar invested? Now we're doing that comparison. I hesitate to say it's the competition, but we really are, because these are all part of the same industry. Conley Industries, the same company, but we really are comparing them to other competitors for invested assets. And so what would our answer be to letter B here? Which one is the most profitable per dollar invested? The retail division. So if you're Conley Industries, if you're the parent company that's over these 3 divisions, and let's just say you have some extra cash floating around to invest, you look at this information and you say, wow, the retail division returns 24%, 24 cents on the dollar for every dollar we invest with them, where the internet division only returns 18 cents on the dollar invested. So if you have some extra investment cash, what are you likely to do with it? You're going to go to the retail division first and say, hey, do you guys have any need for this, for this investment capital we have? We can give you some more money, and then you can decide how to invest it and continue to bring us in 24 cents of profit or operating income for every dollar we hand you. Seems like a pretty good deal. So as I said, return on investment is just one way of looking at or analyzing, evaluating the performance of an investment center. So let me just, before we move on to our next exercise and residual income, let me just throw out one more plug there for the DuPont formula. As I was discussing it, the DuPont formula really points out to us or highlights for us that in order to improve our return on investment, our ROI, we can either improve our profit margin, or we can improve our invested assets or asset turnover. And so if we're looking at the internet division, say for Conley Industries, and we say, you know what, your ROI is only 18%. Compared to the other divisions, you're not doing so very well. And the manager says, I'm open to suggestions. How do we improve this? You can focus on the components that go into that DuPont formula and say, well, you can either improve your profit margin, or you can improve your asset turnover, or some combination of the two. That might be a little bit more beneficial, a little bit more helpful for that manager to understand what is it that goes into the calculation of return on investment. It's a little bit more straightforward than saying, well, you just need to generate more income with your assets. That's a little bit more vague than if we use the DuPont formula to understand where does this result come from. And let's move on. I want to go back to the PowerPoint just for a moment. There we go. And we'll talk about residual income, and that is the focus of our next exercise today. So residual income, what does it mean if something's residual? What does that term residual mean? To say there's a residue on something, what does that mean? Yeah, it's something that's left on there, right? A residue on a glass means you probably didn't do a very good job washing it, and it didn't all come off. Or there's a residue on your phone screen because it needs to be cleaned off. Residual income is what's left of our income after we meet some minimum standard. And so to calculate residual income, we're going to look at, the company needs to determine what's the minimum we expect from you. And let's just say it's 15%. 15% of what? 15% of the invested assets. We expect, remember we just in the last exercise talked about return on investment. The company would set, here's the minimum return on investment we expect from you. And maybe it's 15% or 20% or whatever it is. And so then we take that expectation of the company in terms of a percent or return on investment, and we compare that to the assets that each operating unit has invested. So for example, if my unit has $100,000 worth of invested assets, and the company says to me, we want a minimum of 20% ROI, 20% of the $100,000 that I have invested means they're telling me I need a $20,000 operating income minimum. Does that make sense? So we're giving you these assets. You get to decide how they're invested because you're an investment center, but we need you to bring in 20% ROI. Okay, I translate that in my head to, I need to have a minimum of $20,000 in operating income. The concept of residual income then says, what if I make more than that? If I have $25,000 in operating income, and based on the minimum ROI, I needed 20,000, I got 5,000 extra. That 5,000 extra is the residual income. It's the amount over and above the minimum expectation. So how does a company determine that minimum expectation? What is that minimum rate? And I want to talk just for a moment about something known as the cost of capital, or the weighted average cost of, oh, let me make that a little bit long. I'll give myself a little bit more room here. So the weighted average cost of capital, or the WACC, that's what it's known, is something that you'll hear about in the context of a finance course. So for those of you who are planning to transfer after your degree here at JCC, and you're going to be working on a a bachelor's degree in some business related area, one of the classes that you will almost certainly be required to take is, certainly if you're going toward accounting or finance, is corporate finance. And this is something that you'll talk about much more in depth in corporate finance, but I just kind of want to give you that sense of what that is. So as it says in that final bullet point, that minimum rate is determined by the company, by top management, and they're going to base it on, as it says here, the cost of financing, which is the weighted average cost of capital. So I'm going to use up some more of this white space on the screen just to kind of illustrate this for you. Thinking back to financial accounting, and in chapter 2 in financial accounting, you were introduced to the fundamental accounting equation. And at its very basic, it looked like, if I can type, at its very basic, it looked like this. Assets equals liabilities plus stockholders' equity. And as we went, because you weren't with me, as you went through the semester, we expanded on this concept a little bit. And we changed liabilities into 2 categories. Current, liabilities. Let's hit the insert button. Current liabilities and long-term liabilities. No. So we expanded our liabilities and we said, okay, what do they do? We've got some that are current, and then we've got some that are non-current or long-term. And we also took that stockholders' equity piece and broke that into 2 components. And we called those contributed capital and retained, retained earnings. So this is a bit of an expansion on that original, that fundamental accounting equation. We've broken the liabilities into 2 parts and we've broken the equity into 2 parts. We're just going to leave the asset piece alone for now. So everyone okay with that formula? You know that formula, you're good with that? You understand what all those terms mean, right? So when we talk about the capital structure of a company, specifically of a corporation, we are talking about this. So what I just put in that box is known as the capital structure of the company. And what that means is that's where they get the investment capital. That's where they get the funding to run their company. There are, as you can see in that box, there are really 3 sources of funding, 3 primary sources of funding for a company to expand and grow and run the business. And that's referred to as the capital structure. So long-term liabilities for a corporation, long-term liabilities are primarily the bonds that they issue. And so for most of you, you would have talked about corporate bonds in chapter 11 in financial accounting. We know it's the primary source of borrowing for a corporation. So when we talk about the cost of financing, how do we know what the cost of a bond is? Well, what do we have to pay for the bond? Interest, right? And so the cost of borrowing, the cost of financing through bonds is the interest rate. So that's pretty straightforward. That's pretty easy to figure out. We issued bonds, let's say they're paying 5% interest. In case you didn't see it, the Fed raised interest rates for the 3rd time in the last couple months yesterday. Pretty big news in the economy. So the bond interest rate is the cost of financing that piece, the long-term liability piece. There are other long-term liabilities in there for sure. Companies might have pension liabilities and you know, other sources of capital, but we know that bonds are the primary one. And then as we look at the stockholders' equity piece, we've got contributed capital, which represents the investments by our stockholders. That one's a little bit harder to figure out. What's that worth, or how much is that costing us? But in general, just to give you kind of a definition, the cost of financing through stockholders is what's the expected rate of return for our stock, or for a stock of similar risk in the market. What are stockholders requiring us to provide to them as a return on their investment in order to be willing to stay invested in our company? Or we're making enough money that they're happy to stay invested. And then the retained earnings piece. So retained earnings is the internally generated funds, all the money that we've made and did not pay out to our stockholders in the form of dividends. Again, we can determine, but not in this class, we can determine what do stockholders expect from that. In other words, how much do we need to return to them? How much do we need to make for them so that they're not saying, hey, give me that money back in the form of dividends and I'll invest it someplace else? How much is enough to keep them happy, to keep them thinking that this is a good investment, they're making enough money for us, we want them to keep the money they make and continue to add to that through investment gains. And so the weighted average cost of capital takes into account what's in this box, those three pieces. It takes into account the percentage or portion of our capital structure that each one of those makes up. So maybe our capital structure is, just throwing numbers out there, 25% bonds, 25% investments from stockholders, and 50% internally generated. That is the retained earnings. So those are the weights we would apply to find the weighted average cost of capital. And then we need the cost for each one of those individual components, as I already explained. So as we talk about residual income, as we talk about how much is enough return on investment, as we set that minimum acceptable return on investment, this is what they're taking into account. Well, how much do we need just to keep the company running? How much do we need to keep our stockholders happy and to pay off our bonds, pay the interest on our bonds when they come due? All of that goes into this calculation of the minimum expected return on investment. So for our class, you do not need to be able to calculate that number. In our exercise that we're going to look at in just a second, I just want you to, we'll be given that number, but I want you to recognize where that number comes from. How does a company decide? It says it's up to top management. What goes into that decision? So before I clear the drawings on this page, any questions? Does this make sense? Okay with what those things mean? Okay, where's my formula? Well, I guess I don't have a slide that has the formula. I just told you what the formula was, but when we go to the exercise, I'll put it on the screen so that you can see it. This is what they have there. Is not, I think it's easier, it's more helpful for you to see an actual, written out mathematical type formula. So let me put that on the screen here. Put it up at the top, right? Because since it already has residual income there, I'll just put my formula there. So the residual income is the operating income minus, I'm going to put this in parentheses, even though it doesn't really need to be in parentheses because of order of operations, but it'll make it clearer what we're doing. There we go. Okay, so I've already explained how this is calculated. I like to start with what's in parentheses. So we are told that this company has established a 15% accepted, acceptable rate of return. So they are demanding, requiring at minimum a 15% ROI from each one of these divisions. And so let's start with the retail division again. The retail division has $40 million in invested assets. So at a 15% minimum rate of return, the minimum operating income that the company expects would be, what's 15% of $40 million? Oh, whoops, I've got room to put that down there. Sorry, didn't really need to put that there. I have room to put it right down here. Come on. Just going to make that a little bit smaller so I have room for it on my screen. Almost. There we go. Okay. So the minimum acceptable operating income for the retail division, 15% of the invested assets, or $6 million. Everyone okay with where that came from? Okay. The retail division actually returned in operating income $9.6 billion. So the excess, the residual, what's left over is $3,600,000. They have excess or residual income beyond the minimum that was required of them of $3.6 million. Which seems pretty good to me. But let's look at the other two divisions, and I'll ask you to calculate those on your own. So again, we start with the assets invested multiplied by the minimum requirement, and then compare that to the operating income. Excuse me. So to answer our question in part B, which division has the most residual income, our answer would be which of the three divisions has the most residual income?
The commercial division.
The commercial division. Okay. So some of these numbers may have looked familiar from the previous exercise. I mean, get that formula off the screen. So put my green check marks in there. So in the last exercise, as we looked at return on investment, we said that the retail division had the best return on investment, but they have fewer assets than the commercial division, right? So their income is lower. Even though they have the best ROI, their income is lower because we haven't given them as much to work with. And I had suggested to you in this exercise that if the company has additional money to invest in new assets, they might target the retail division for investment because they're the ones who are producing the most income with what they have. But based on what they have, based on, the commercial division has more, that's how they get more residual income as well, because they are covering the minimum requirement and then something on top of that. Now, as a percent, the residual income would be lower, but in terms of sheer dollars, the commercial division looks the best when we use this measure of residual income. Just comparing those two probably tells you why we wouldn't want to choose just one of these measures to use, because we might miss something in that analysis. Looking at ROI, we said it's the retail division that's doing the best in terms of generating income with what they have, but that was as a percent, not as a dollar amount. So it's always a good idea to keep track of more than one of these financial analysis tools, that we might get a more comprehensive picture by using multiple approaches to do that. In our next exercise then, in exercise 9, we're going to be using that DuPont formula. So I'll give you, if you didn't make a note of them before, I will give you the formulas for each of the components. Whoops, here. I'll give you the formulas here on the screen, and then I'm going to ask you to try part A on your own. So I'm just going to put the formulas here on the screen. For profit margin, it is operating income divided by sales or revenues. For investment turnover, also known as asset turnover, it is the, let's have a little more room, sales divided by invested assets. And then ROI is the product of both of those, profit margin times investment turnover. So I'm going to pause the recording and ask you to do part A on your own. If you want, you can then use the check my work button to make sure you've got it, and restart the recording once you have part A, or if you need help. Okay, so I've showed my calculations there. The profit margin is operating income divided by sales, for 17%. So in other words, for every dollar in sales, I get to keep 17 cents as operating income. Investment turnover is sales divided by invested assets, and my turnover is 1.6. For every $1 in invested assets, they're generating $1.60 in sales. And so using the DuPont formula, multiplying those two numbers together, we get an ROI of 27.2. For every dollar in assets, we get to keep 27.2 cents in operating income. So letter B says, well, what if we could cut our expenses without impacting sales? And so what would be the impact of that? If we cut our expenses, our operating income would increase by the same amount that we cut our expenses. Revenues stay the same, expenses go down. And so we just need to tweak our calculations a little bit here. So rather than 39,100,000 in operating income, we would actually have 3,450,000 more than that. Would investment turnover change? Investment turnover is based on sales and invested assets. So that would actually stay exactly the same at 1.6. So let's recalculate our profit margin. Now we knew it was going to go up. We knew it would go up because we added directly to the bottom line. And then again, using that DuPont formula, we can multiply those two calculations together. 18.5% times 1.6 gives us a new return on investment of 29.6. And so our profit margin went up by 1.5%, but because that investment turnover magnifies it, our return on investment didn't only go up 1.5%, it actually went up 2.4%. So we get an extra boost from that investment turnover for our return on investment. And so the usefulness of this exercise is it helps us to see that really improving one or the other, or maybe a little bit of both of those two pieces that make up return on investment, can help our bottom line, can help our company. Okay, before we shift to our final topic for chapter 24, anyone have any questions about evaluating the performance of a cost center, a profit center, or an investment center? Okay, let me clear my drawings. And then we'll go to our final topic and our final exercise for this chapter, which is about transfer pricing. So on Tuesday, when I was giving you an overview of this chapter and what we'd be talking about, I said sometimes different operating units or business units, or in this case, what they're calling them in this slide, divisions of the same company, can actually be customers of each other. Okay, so in this case, they're showing that Division X might be selling product or services to Division Y, or vice versa. And we said that on Tuesday that part of the problem is you forget that you're all on the same team. That is, the incentives are not necessarily aligned to help you improve the overall profitability of the company, but instead you get focused on just your little area of the company. So if Division X, if the manager of Division X is being evaluated based strictly on the performance of Division X, then the goal of that manager is going to be to maximize the profitability of Division X, even if it hurts the company as a whole. Using what we have here on the screen, what would that look like? Well, maybe Division X would be overcharging Division Y for a product or service that's really being transferred within the same company. So again, it's really easy to forget if we don't reward the appropriate behavior or incentivize maximizing the profitability of the company as a whole, we risk helping one division at the expense of the other division, again, using the terms that are here on the screen. So in our final exercise for this chapter, we're going to talk about when a company does have two divisions or two operating units that are doing business with each other, how do they decide how much that they should be charging their internal customers? How do we decide how much they should be charging their internal customer? And we call that the transfer price, because it really isn't an intra-company transfer. You can see the three options here: market price, negotiated price, and cost approach. And we're going to be looking at those in our final exercise. So there are really two extremes, or we could negotiate something in the middle. So transfer prices, as you can see on this slide, transfer prices, the lowest a division or operating unit would be willing to accept is, what did it cost us to produce it? With what we understand about fixed costs, we know that their fixed costs would not go up just because they chose to produce and transfer product or provide services to another division. So it might be appropriate to ignore those fixed costs when we're doing an intra-company transfer. But those variable costs are costs that they're only incurring because they're making that product. So at a minimum, the transfer price should be set at that variable cost per unit. So that's your minimum. The maximum that they should be charging as that transfer, recording as that transfer price is how much could they get for it if they sold it to a non-related party? What if they just went into the market? What do they charge their normal customers, someone who's not part of the same company? And so that price should be the upper limit. And so now we've established the limits to the terms of this transfer. The price could be as low as the variable cost per unit, as high as the market price per unit, or they could negotiate some point in between. They could agree to split the difference. And I'm not suggesting it would have to be halfway in between those two numbers, but really anything in between those two numbers benefits the company as a whole. Let's go to our exercise and see what this looks like when we put actual numbers to it. Hang on, let me. Okay. Exercise 10 says, materials used by the instrument division of Ziegler Incorporated are currently purchased from outside suppliers at a cost of $13.50 per unit. However, the same materials are available from the components division. The components division has unused capacity. So remember, we've talked about in earlier chapters that term capacity and what that means. We're not talking about theoretical capacity here. We're talking about practical capacity. The components division could produce the materials needed by the instrument division without any change to their fixed costs. They have capacity that they're not using within their practical capacity. And so the components division could produce them. And as you can see in the given information, they could produce them at a variable cost of $900 per unit. So now we've established the limits to our transfer pricing. Anything less than $900 for the transfer price, and the components division loses money, right? So the manager of the components division would never agree to that. If it costs us $900 in variable cost just to produce it, why would we sell them to the instrument division for $800? Now my division looks worse because I added $900 to my cost and only $800 to my revenues. Not going to do that. On the other side, though, the instrument division can buy them from someone outside the company, some other company. They can buy them for $13.50. They would never agree to pay $1,400 to the components division because they can get them cheaper by going outside the company. Anything less than $13.50, the company as a whole is better off, right? Because right now they're being purchased for $13.50. And we can make them for $900. If we charge anything less than $13.50, the company's better off as a whole. Let's see, letter A says, if a transfer price of $1,000 per unit is established and 75,000 units of material are transferred with no reduction in the components division's current sales, how much would Ziegler Incorporated's total operating income increase? So we're looking at the company as a whole. Well, if they didn't buy them internally, they would be paying $1,350, right? If they make them internally, it's only going to cost the company as a whole $900. Does everyone agree with that? So instead of paying $13.50, we're incurring cost of $900. For the company as a whole, that's a savings of $450 per unit for each of those 75,000 units. The company as a whole would increase their bottom line by $33,750,000. Rather than spending $13.50 per unit, they only spend $900. Everyone agree that that's what they should do? They have that unused capacity. They can increase their bottom line by $33,750,000. Sounds like a good plan, right? Certainly sounds like a good plan to me. But now we have to agree, the two divisions or someone has to determine what's the transfer price going to be. We've already established in letter A, this is a good deal. The company as a whole will make almost $34 million more by doing this. But who gets to claim that $34 million on their divisional income statement? So this is where we need to be careful what we incentivize. If we are looking, if these divisions, the instrument division and the components division, if they are, well, whether they are profit centers or investment centers, we're looking at that operating income as we evaluate the management of that division, right? We are looking at that operating income, whether they are profit center or an investment center. That operating income is part of our evaluation of their performance. So how do we decide who gets that $33 million? Or how do we split it up? Because part of that income is going to be reported for the instrument division, and part of it is going to show up for the components division. So how do we decide that? As I said, the limits are the instrument division gets all of it, or the components division gets all of it, but maybe the equitable or the appropriate position is somewhere in the middle. And we are told in letter A that we established a transfer price of $1,000. So we have, I don't know who established that transfer price. I don't have an answer for you who should be establishing that. I don't know if that comes from top management, you know, whoever's above these divisions. I don't know. But they didn't split the difference. They didn't say, well, halfway between 900 and 1350 would be what, 1125? They didn't say, let's call it 1125. Someone decided that the price was $1,000 per unit. So the instrument division went from paying $1350 to now only paying $1,000, right? The instrument division saved $350 for each one of those 75,000 units. They saved $350 for each of those 75,000 units. That's 26,000 and, sorry, 26 million, $26.25 million. Their income would increase. The components division's sales go up by 1,000 times 75,000 units. But they're only realizing, they're only making $100 on each one of those units. $100, the difference between their variable cost and the transfer price. Using a term from a previous chapter, each of these units has a $100 contribution margin. After we cover the $900 in variable costs, they have an extra $100 that goes straight to the bottom line. $75,000 units times $100. The components division's operating income would increase by $7.5 million. Now, I don't know whether we look at this and say, well, that's not fair. Or maybe it is fair. I don't know. We know from letter A that the position of the company as a whole is improved by $34 million. And it's the same $34 million whether they chose a transfer price of 900, 1,000, 1,200, 1,350. The same improvement to the bottom line, because Think about the formula, the calculation we used in letter A. We didn't even need to know what the transfer price was to determine the improvement for the company as a whole. Doesn't matter what they set the transfer price. The company's still almost $34 million better off. But if you're the head of the components division, are you happy about, what is that, 3/4 of the profit of the excess, the additional income gets allocated to the instrument division? And it's pretty arbitrary, right? It's pretty arbitrary. There's no reason that, at least not that we're presented here, there's no reason that they chose $1,000 instead of 50-50 split, you know, calling it 1125. But we need to be careful about how we incentivize this, that we don't have infighting, that we remember we're all in this exercise. All of these people are part of Ziegler Incorporated. We're all pushing for the same, or pulling for the same team. And the answer to letter A does not change regardless of what our transfer price is. That is the end of what we're going to talk about from chapter 24. Any questions, anything you want to talk about from the project that's due next class, anything else? Not in class, at the end of the day on our next class day. I'm going to go ahead and hit stop on the recording then.